If you are over 55 years old and you have $200,000 saved for retirement, I have good news and I have realistic news. The good news is that $200,000 properly managed can generate meaningful retirement income for the rest of your life. The realistic news is that it requires discipline, the right strategy, and an honest assessment of what is possible. Too many people reaching retirement age have either saved too little or have no plan for turning their savings into sustainable income. They have accumulated a pile of money without understanding how to make that money work for them. Today, I am going to give you a complete blueprint for transforming $200,000 into reliable retirement income. This is not about getting rich. This is about not running out of money. This is about creating a paycheck that arrives every month for the rest of your life, replacing the paycheck from the job you are leaving behind. This is about sleeping well at night, knowing your financial future is secure. Let me start by being honest about what $200,000 can and cannot do. $200,000 is not a fortune. It will not fund a lavish retirement of world travel and luxury purchases, but it is enough to provide meaningful income that, combined with Social Security, can fund a comfortable retirement for many Americans. The traditional rule of thumb suggests withdrawing 4% of your portfolio annually. 4% of $200,000 is $8,000 per year, or about $667 per month. That alone will not pay many bills. But here is where the strategy becomes important. That 4% rule assumes you withdraw from principal. I am going to show you how to generate income from your portfolio without depleting principal, or at least while depleting it much more slowly. And I am going to show you how to combine that income with Social Security and other sources to create a retirement income that actually works. The first step in my blueprint is understanding your complete financial picture. Before you can create a retirement income strategy, you need to know exactly what you have and what you need. This seems obvious, but most people skip this step. They have a vague sense of their finances rather than precise knowledge. Start by listing every asset you own, the $200,000 in retirement accounts, any other savings or investment accounts, home equity if you own your home, any pensions you are entitled to, the cash value of life insurance policies, everything. Then estimate your Social Security benefit. If you are 55, you can get an estimate from the Social Security Administration website. This estimate will show what you would receive at 62, at full retirement age, and at 70. These numbers matter enormously for your planning. For most Americans, Social Security will provide the majority of retirement income. The average Social Security benefit is around $1,800 per month. If you earned above average income during your career, your benefit might be $2,500 or even $3,000 per month. Now list your expected expenses in retirement, housing costs including mortgage or rent, property taxes, insurance, and maintenance, healthcare costs including insurance premiums, out-of-pocket expenses, and prescriptions, food and household expenses, transportation, utilities, entertainment, everything you will need to spend money on. Be honest in this assessment. Many people underestimate retirement expenses, especially healthcare costs, which tend to rise significantly as you age. Better to overestimate expenses and be pleasantly surprised than to underestimate and run out of money. The gap between your expected expenses and your guaranteed income from Social Security and any pensions is what your $200,000 must fill. If your expenses are $4,000 per month and Social Security provides $2,000, your portfolio must generate $2,000 per month or $24,000 per year. That is a 12% withdrawal rate, which is not sustainable. If this is your situation, you either need to reduce expenses, delay retirement, or accept that your principal will be depleted over time. There is no magic solution that makes the math work when the numbers do not add up. But if your gap is smaller, if Social Security covers most of your expenses, and you only need to generate $500 or $1,000 per month from your portfolio, then $200,000 can absolutely provide that income sustainably. The second step is optimizing Social Security, which is the foundation of retirement income for most Americans. Social Security is the best annuity most people will ever have access to. It is inflation adjusted, meaning payments increase with the cost of living. It is guaranteed for life, meaning you cannot outlive it. It is backed by the federal government, meaning the credit risk is essentially zero. The decision when to claim Social Security is one of the most important financial decisions you will ever make, and most people get it wrong by claiming too early. You can claim Social Security as early as 62, but your benefit will be permanently reduced by about 30% compared to claiming at full retirement age. If your full retirement age benefit would be $2,000 per month, claiming at 62 reduces it to around $1,400 per month forever. Conversely, if you delay claiming until 70, your benefit increases by about 8% per year beyond full retirement age. That same $2,000 benefit becomes approximately $2,640 per month. If you wait until 70 forever, the math strongly favors delaying for most people. Yes, you receive fewer checks by waiting, but each check is larger, and if you live to average life expectancy or beyond, you will receive more total dollars by delaying for someone with $200,000 saved. The optimal strategy is often to use portfolio withdrawals to bridge the gap between retirement and age 70, then claim the maximum Social Security benefit. You spend down some of your portfolio during your 60s, but you lock in a permanently higher guaranteed income stream that lasts the rest of your life. Let me illustrate with numbers. Suppose you retire at 62 with $200,000 saved. Your Social Security benefit at 62 would be $1,600 per month. At 70, it would be $2,800 per month. If you claim at 62, you receive $1,600 per month from Social Security to cover $3,000 per month in expenses. You need $1,400 from your portfolio. That is $16,800 per year, an 8.4% withdrawal rate that will likely deplete your savings within 15 years. Alternatively, if you wait until 70 to claim, you withdraw $36,000 per year from your portfolio for 8 years, spending $144,000 of principal. But then at 70, you receive $2,800 per month from Social Security, covering most or all of your expenses. Your remaining $56,000 plus growth stays invested as a reserve. The delayed claiming strategy provides more total income over a typical retirement, despite spending down more principal initially, and it provides more security because the guaranteed income is higher. This calculation varies based on your specific circumstances, health, and other factors, but for most people over 55 with modest savings, maximizing Social Security should be the foundation of retirement income planning. The third step is constructing a portfolio that generates reliable income. Once you understand your income gap and have a Social Security strategy, you can design your investment portfolio to fill the remaining need. For someone with $200,000 seeking income, the portfolio construction looks different than for someone in accumulation mode. The goal is no longer maximum growth. The goal is reliable income with reasonable growth to maintain purchasing power. This shift in objective changes everything about how you invest. I recommend dividing your $200,000 into 3 buckets, each with a different purpose and time horizon. The first bucket is your cash reserve. This should hold 2 to 3 years of portfolio withdrawals in cash, or cash equivalents like money market funds and short-term treasury bills. If you need $12,000 per year from your portfolio, this bucket holds $24,000 to $36,000. The cash reserve serves 2 purposes. First, it provides the money you will actually spend in the next 2 to 3 years, giving you certainty about near-term income. Second, it allows you to avoid selling stocks during market downturns. When stocks fall, you draw from the cash bucket rather than selling depreciated shares. This prevents sequence of returns risk. which is the danger of selling low early in retirement and permanently impairing your portfolio. The second bucket is income-producing investments. This should hold 40 to 50% of your portfolio in dividend-paying stocks, bonds, and other income-generating assets. These investments produce regular cash flow that replenishes your cash bucket and provides ongoing income. For the dividend stock portion, I recommend focusing on companies with long histories of paying and increasing dividends. Companies like those I have owned for decades, Coca-Cola, Johnson & Johnson, Procter & Gamble. These businesses generate reliable cash flows and return much of that cash to shareholders. Dividend yields of 3 to 4% are common among high-quality dividend payers. For the bond portion, focus on investment-grade corporate bonds and treasury bonds with intermediate maturities of 5 to 10 years. These provide regular interest payments with modest price volatility. Avoid junk bonds that offer higher yields but carry substantial default risk. Avoid long-term bonds that are highly sensitive to interest rate changes. The third bucket is growth investments. This should hold the remainder of your portfolio, perhaps 30 to 40%, in diversified stock funds focused on long-term appreciation. This bucket provides the growth needed to maintain purchasing power over a retirement that could last 30 years or more. For the growth portion, a low-cost index fund tracking the broad stock market is appropriate for most investors. You do not need to pick individual stocks or time the market. You simply need diversified exposure to the long-term growth of American business. The three-bucket approach provides a mental framework that makes retirement income manageable. That the next few years are covered by the cash bucket. That income investments are replenishing that cash. That growth investments are providing long-term purchasing power protection. The fourth step is implementing a sustainable withdrawal strategy. With your portfolio constructed, you need a systematic approach to withdrawing money. This is where many retirees fail. They withdraw too much too fast and deplete their savings prematurely. The traditional 4% rule suggests withdrawing 4% of your initial portfolio value in the first year, then adjusting that amount for inflation each year thereafter. With $200,000, that means $8,000 in year one. Then perhaps $8,200 in year two if inflation is 3%, and so on. This rule has been tested against historical market returns and has a high probability of sustaining a portfolio for 30 years, but it is not a guarantee. And it may be too aggressive if you retire during a period of poor market returns. I recommend a more conservative approach for someone with $200,000. Start with a 3 to 3.5% withdrawal rate, which is $6,000 to $7,000 per year. This lower rate provides a larger margin of safety and increases the probability that your money lasts as long as you do. You might object that $6,000 per year is not much income. You are right, but remember, this is supplemental income on top of Social Security. If Social Security provides $20,000 per year and your portfolio provides $6,000, your total income is $26,000 per year, or about $2,200 per month. For many retirees with paid-off homes and modest lifestyles, this is sufficient. The withdrawal strategy should also be flexible. In years when your portfolio performs well, you might withdraw slightly more. In years when markets decline, you might withdraw less and cut discretionary spending. This flexibility extends the life of your portfolio significantly compared to rigid withdrawal rules. As you age, you can gradually increase your withdrawal rate. At 55, you might need your money to last 40 years, requiring a conservative withdrawal rate. At 75, you might only need it to last 20 years, allowing a higher withdrawal rate. Adjusting over time matches your withdrawals to your remaining life expectancy. The fifth step is minimizing taxes on retirement income. Taxes can consume a significant portion of your retirement income if you do not plan carefully. Different types of income are taxed differently, and strategic planning can reduce your tax burden substantially. Social Security benefits may be partially taxable depending on your total income. If your combined income exceed certain thresholds, up to 85% of your Social Security benefits can be subject to federal income tax. Understanding these thresholds and managing your other income accordingly can reduce the tax on Social Security. Withdrawals from traditional retirement accounts like 401k plans and traditional IRAs are taxed as ordinary income. This is the highest tax rate, potentially reaching 22 or 24% or higher for some retirees. These withdrawals also count toward the income thresholds that determine Social Security taxation. Withdrawals from Roth accounts are tax-free if the account has been open for at least 5 years and you are over 59 and a half. Roth withdrawals do not count toward Social Security taxation thresholds. Having Roth assets in retirement provides flexibility to manage your tax situation. Qualified dividends and long-term capital gains are taxed at preferential rates, currently 0% for lower income taxpayers and 15 or 20% for higher income taxpayers. Generating income through dividends rather than retirement account withdrawals can reduce your overall tax burden. The optimal strategy for most retirees is to withdraw from different account types in different years to minimize lifetime taxes in years when your income is low, perhaps before Social Security begins. You might do Roth conversions to move money from traditional accounts to Roth accounts at low tax rates. In years when your income is higher, you might rely more heavily on Roth withdrawals and qualified dividends. This tax optimization requires planning and perhaps professional advice. But the savings can be substantial, potentially tens of thousands of dollars over a retirement. The sixth step is planning for healthcare costs, which are the biggest wild card in retirement planning. Healthcare expenses in retirement are substantial and unpredictable. The average retired couple will spend over $300,000 on healthcare during retirement. And that is just an average. Actual costs could be much higher, especially if you need long-term care before Medicare eligibility at 65. Healthcare can be extremely expensive. If you retire at 55, you need to cover 10 years of healthcare before Medicare begins. Options include COBRA continuation from your previous employer, individual health insurance purchased on the marketplace, or a spouse's employer coverage if available. Marketplace plans can be expensive, but subsidies are available for those with modest incomes. Understanding how your retirement income affects subsidy eligibility is important for managing healthcare costs during this period. Once Medicare begins at 65, costs become more predictable but still substantial. Medicare Part A covers hospital care and is usually premium-free. Medicare Part B covers doctor visits and other outpatient care, with premiums that depend on your income. Medicare Part D covers prescription drugs with its own premiums and cost-sharing structure. Most retirees also purchase supplemental coverage to fill the gaps in Medicare. Medigap policies cover cost, sharing that Medicare does not pay. Medicare Advantage plans provide all-in-one coverage through private insurers. Understanding these options and choosing appropriately is essential for managing healthcare costs. Long-term care is the largest potential healthcare expense. Nursing home care can cost over $100,000 per year. Home health care is cheaper but still expensive for extended periods. Medicare does not cover most long-term care costs. Medicaid covers long-term care only after you have spent down nearly all your assets. Long-term care insurance can protect against this risk, but it is expensive and premiums have increased dramatically in recent years. Self-insuring by maintaining assets to cover potential long-term care costs is another approach, but requires substantial savings. For someone with $200,000, long-term care represents a significant risk. If you or your spouse needs extended care, it could quickly deplete your savings. This risk argues for conservative withdrawal rates, maintaining assets as long as possible to provide a cushion against potential care needs. The seventh step is creating additional income streams if possible. For many people over 55 with $200,000, the income from Social Security and portfolio withdrawals may not be sufficient. Creating additional income streams can fill the gap and reduce pressure on your savings. Part-time work is the most common additional income source for early retirees. Working 15 or 20 hours per week at even a modest wage generates meaningful income. Earning $1,000 per month from part-time work is equivalent to having an additional $300,000 saved, based on a 4% withdrawal rate. Part-time work also provides structure, social interaction, and purpose that many retirees miss after leaving full-time careers. The income benefits and psychological benefits combine to make part-time work an attractive option for many. Rental income from real estate can provide another income stream. If you own your home with equity, downsizing to a smaller home could free up capital to invest. If you have additional property, renting it generates monthly income. Real estate requires active management, but can provide inflation-protected income. If you have skills or expertise from your career, consulting or freelance work can generate income on a flexible schedule. Many retirees find that companies value their experience and are willing to pay for it on a project or advisory basis. Social Security spousal benefits can increase household income if you are married and one spouse earns significantly more than the other. The lower-earning spouse can claim benefits based on the higher-earning spouse's record, potentially increasing total household benefits. Each additional income stream reduces the burden on your $200,000. If you can generate $500 per month from part-time work, that is $6,000 per year, you do not need to withdraw from savings. Over a 30-year retirement, that preserves $180,000 of principal, a meaningful difference. The eighth step is protecting against the unexpected. Even the best retirement plan can be derailed by unexpected events. Health emergencies, market crashes, family obligations, inflation spikes. Building protection against these risks is essential. An emergency fund should be maintained throughout retirement. This is separate from your investment portfolio and should cover 3 to 6 months of expenses. If the unexpected happens, you draw from the emergency fund rather than selling investments at an inopportune time. Insurance protects against catastrophic risks. Health insurance is essential until Medicare. Medicare supplemental coverage fills gaps once Medicare begins. Homeowners or renters insurance protects your property. Auto insurance is required for drivers. Umbrella liability insurance provides additional protection against lawsuits. Estate planning documents protect you and your family. A will directs distribution of your assets. A durable power of attorney allows someone to manage your affairs if you become incapacitated. A healthcare proxy designates someone to make medical decisions if you cannot. A living will specifies your wishes for end-of-life care. Beneficiary designations on retirement accounts and insurance policies should be reviewed and updated. These designations override your will, so keeping them current is essential. Many families have been surprised to discover that outdated beneficiary designations directed assets to ex-spouses or deceased relatives. Fraud protection is increasingly important for retirees who are common targets of financial scams. Be skeptical of unsolicited calls, emails, and mail promising guaranteed returns or requiring immediate action. Never give personal financial information to strangers. Monitor your accounts regularly for unauthorized transactions. Let me now put this all together with a specific example of how the blueprint works in practice. Imagine you are 57 years old with $200,000 in a 401k. You want to retire at 62. Your estimated Social Security benefit at 62 is $1,600 per month. Or at 70, it would be $2,800 per month. Your monthly expenses in retirement will be approximately $3,000. First, you decide to delay Social Security until 70 to maximize the benefit. This means you need to cover all expenses from your portfolio from ages 62 to 70. Then Social Security covers most expenses thereafter, From 62 to 70, you need $36,000 per year for expenses over 8 years. That is $288,000 total. Your $200,000 cannot fully cover this. So you plan to work part-time and earn $12,000 per year, reducing the portfolio withdrawal to $24,000 per year, or $192,000 over 8 years. You construct your portfolio with $30,000 in cash equivalents covering roughly 15 months of withdrawals. You put $100,000 in income, producing investments yielding about 4%, generating $4,000 per year to partially replenish the cash bucket. You put $70,000 in diversified stock index funds for growth. Over the 8 years before Social Security begins, you withdraw from the cash bucket, replenishing it with dividend income and occasional sales from the income and growth buckets. The portfolio declines, but hopefully grows enough that you still have $50,000 to $75,000 remaining at age 70. Age 70 Social Security begins at $2,800 per month. Your expenses are $3,000 per month. The gap is only $200 per month, or $2,400 per year. Your remaining portfolio easily covers this gap, and you stop depleting principal. Your remaining $50,000 to $75,000 serves as an emergency fund and cushion for unexpected expenses. It can also fund discretionary spending, travel, gifts to grandchildren, or other enjoyments, and it can potentially grow if not needed, providing a legacy for heirs. This example illustrates how the blueprint works. Maximize guaranteed income through Social Security delay. Bridge the gap with portfolio withdrawals and part-time income. Construct the portfolio for income and reasonable growth. Withdraw sustainably. Minimize taxes. Plan for health care. Protect against the unexpected. Let me address some common concerns and questions. What if I cannot work part-time due to health issues or caregiving responsibilities? Then you need to accept either lower expenses or faster depletion of principal. There is no way around the math. If income is insufficient and work is impossible, expenses must decrease or savings must be spent more quickly. What if the market crashes right when I retire? This is sequence of returns risk. And it is why the cash bucket is so important. If you have 2 to 3 years of expenses in cash, you can ride out a market downturn without selling stocks at depressed prices. The market has always recovered from crashes eventually, and maintaining your stock allocation through the recovery is essential. What if inflation surges and my expenses increase dramatically? This is why maintaining equity exposure matters. Stocks provide long-term protection against inflation because corporate earnings and dividends tend to rise with prices over time. A portfolio of only bonds and cash would be devastated by sustained high inflation. What if I live much longer than expected? Longevity risk is real. Someone who is 55 today has a reasonable chance of living past 90. Your plan must account for potentially 40 years of retirement. Conservative withdrawal rates and maximizing Social Security both help address longevity risk. What if healthcare costs are higher than expected? This is the hardest risk to manage. Maintaining savings as long as possible provides a buffer. Long-term care insurance may be appropriate despite its cost. Ultimately, Medicaid provides a safety net for those who exhaust their resources, though qualifying requires spending down nearly all assets. Let me close with some perspective on what a successful retirement looks like with modest savings. $200,000 is not enough to fund a luxurious retirement. You will not be flying first class to European vacations or buying a beach house, but it is enough, combined with Social Security and perhaps some part-time work, to fund a comfortable retirement with your basic needs met and some money for enjoyment. The key is aligning expectations with reality. A comfortable retirement with $200,000 means a paid-off home or affordable housing. It means cooking at home rather than dining out frequently. It means staycations and road trips rather than exotic international travel. It means finding joy in simple pleasures rather than expensive ones. Many of the happiest retirees I know are not the wealthiest. They are the ones who have enough, who live within their means, who find satisfaction in family, community, and purpose rather than in consumption. Financial security does not require millions of dollars. It requires having enough to meet your needs and the wisdom to define your needs modestly. If you are over 55 with $200,000, you can achieve this security. It requires planning, it requires discipline, it requires realistic expectations, but it is absolutely achievable. Follow the blueprint I have outlined. Understand your complete financial picture. Optimize Social Security by delaying if possible. Construct a portfolio for income and reasonable growth. Implement a sustainable withdrawal strategy. Minimize taxes, plan for health care. Create additional income streams if you can. Protect against the unexpected. Do these things, and your $200,000 can provide retirement income for the rest of your life. You will not be rich, but you will be secure. And security, the knowledge that you will not run out of money, is worth more than any luxury. That is the blueprint. That is how you turn $200,000 into retirement income. Now the execution is up to you. Start today, because every year you wait is a year of potential growth and optimization lost. Your future self will thank you for the planning you do today. And the peace of mind that comes from having a solid plan is itself a reward. Starting right now, take control of your financial future. $200,000 is enough if you manage it wisely, and now you know exactly how to do that. Let me spend some additional time discussing the specific investments that work best for this blueprint, because the details matter for the cash bucket. You want maximum safety and liquidity. Money market funds are excellent choices. They invest in very short-term, high-quality debt instruments and currently yield around 5%. Treasury bills purchased directly from the government are another option, providing the same government backing with no credit risk. High-yield savings accounts at online banks often pay competitive rates with FDIC insurance up to $250,000. Do not reach for yield in the cash bucket by buying riskier investments. The purpose of this bucket is absolute safety and availability. Accepting a slightly lower yield for guaranteed preservation of principal is the right trade-off for the income bucket dividend. Focused exchange traded funds provide diversification across many dividend-paying companies, funds that track dividend aristocrats, companies that have increased dividends for 25 or more consecutive years, offer both income and growth. The yields on these funds typically range from 2.5% to 3.5%, with the potential for dividend growth over time. Individual dividend stocks can also work for investors comfortable with stock selection. Focus on companies with long histories of dividend payments and increases. Look for payout ratios below 60%, indicating the dividend is well covered by earnings. Avoid companies with extremely high yields, which often signal financial distress and impending dividend cuts. For bonds in the income bucket, bond funds provide diversification that is difficult to achieve with individual bonds. Intermediate term bond funds, with durations of 5 to 7 years, offer reasonable yields without excessive interest rate risk. Investment-grade corporate bond funds yield more than treasury funds while accepting modest credit risk. Individual bonds can work for larger portfolios where you can build a diversified ladder of maturities. Buying bonds that mature at different intervals provides predictable cash flows and reduces interest rate risk. However, transaction costs and minimum purchase requirements make individual bonds impractical for smaller portfolios. For the growth bucket, total stock market index funds provide the broadest diversification at the lowest cost. Funds tracking the entire United States stock market give you exposure to large, medium, and small companies across all industries. The expense ratios on these funds are often below 5 basis points, meaning you keep almost all of the returns. International diversification can add another dimension to the growth bucket. Developed market international funds provide exposure to companies in Europe, Japan, and other advanced economies. Emerging market funds provide exposure to faster-growing economies in Asia, Latin America, and elsewhere. A modest allocation to international stocks, perhaps 20 to 30% of the growth bucket, provides diversification benefits without excessive complexity. Avoid the temptation to chase performance by concentrating in recent winners. The sector that performed best last year is rarely the sector that performs best next year. Broad diversification ensures you participate in whatever areas of the market perform well, without the risk of being concentrated in whatever performs poorly. Let me also discuss the mechanics of actually implementing withdrawals, because this is where many retirees struggle. The simplest approach is systematic withdrawals, where you take a fixed dollar amount each month from your brokerage account. Most brokerages allow you to automate this process, having a specific amount transferred to your checking account on a specific day each month. This creates the paycheck-like regularity that many retirees want. The withdrawal should come from the cash bucket first. As the cash bucket depletes, you replenish it periodically by selling from the income or growth buckets. Annual rebalancing is a natural time to do this replenishment. If stocks have performed well and exceeded their target allocation, sell stocks to bring the allocation back to target and use the proceeds to refill the cash bucket. This approach means your cash bucket provides 1 to 2 years of known income at all times. You never wonder where next month's money will come from. It is sitting in the money market fund waiting to be transferred. During market downturns, you rely entirely on the cash bucket without selling stocks. This is the critical discipline that protects against sequence of returns risk. When stocks are down 30%, the worst thing you can do is sell to fund living expenses. Let the cash bucket absorb the withdrawals while you wait for markets to recover. If a downturn persists long enough to deplete the cash bucket entirely, you may need to sell bonds rather than stocks. Bonds typically decline less during stock market crashes and recover more quickly. Selling bonds to fund expenses while maintaining your stock allocation gives stocks time to recover. Only in the most severe and prolonged downturns should you consider selling stocks at depressed prices. If you reach that point, reducing discretionary expenses first is preferable to selling depreciated assets. A year of reduced spending is far better than locking in losses that take years to recover. Let me address the psychological challenges of retirement income management, because the emotional aspects are as important as the financial mechanics. The transition from accumulating wealth to spending it down is psychologically difficult for many people. After decades of watching your portfolio grow, seeing it decline, even intentionally through withdrawals, feels wrong. Many retirees become so anxious about spending their savings that they live unnecessarily frugally and die with more money than they started with. This is not a successful retirement. The purpose of saving is to eventually spend. If you reach the end of life with substantial assets remaining, you have either saved too much, spent too little, or failed to enjoy the fruits of your labor. None of these outcomes is optimal. Give yourself permission to spend. You earned this money, you saved it for this purpose. Enjoying it in retirement is not wasteful. It is the entire point. At the same time, spending anxiety often reflects legitimate fear of running out of money. The best antidote to this fear is a well-constructed plan that you understand and trust. If you know your withdrawal rate is sustainable, if you understand how the three-bucket strategy protects against market downturns, if you have done the math on how long your money will last, you can spend with confidence rather than fear. Some retirees benefit from professional advice, not because they cannot understand the concepts, but because having an expert validate their plan provides emotional reassurance. A fee-only fiduciary financial planner can review your situation, confirm your plan is sound, and provide ongoing guidance. The cost of this advice, typically 1% of assets annually or a flat fee for periodic reviews, may be worthwhile for the peace of mind it provides. Let me also discuss how to think about leaving money to heirs versus spending it yourself. Many retirees prioritize leaving an inheritance to children or grandchildren. This is a personal value judgment, and there is no right answer. But consider the trade-offs carefully, sacrificing your own quality of life to leave money to heirs who are themselves affluent may not serve anyone well. Your children in their 50s may not need or benefit from an inheritance as much as you would benefit from spending that money on yourself. Conversely, if your heirs have genuine needs, a home down payment for young grandchildren or education funding for great-grandchildren, directing money toward those purposes may create more value than your own consumption. Talking openly with family about finances and intentions can prevent misunderstandings. If you plan to spend your money and leave little behind, letting heirs know prevents them from building expectations based on assumptions. If you plan to leave an inheritance, discussing your wishes ensures the money serves the purposes you intend. For someone with $200,000, the reality is that little may be left to inherit if you live a long life and maintain a reasonable standard of living. This is not a failure. The money served its purpose by providing for your retirement. That is exactly what it was for. Finally, let me emphasize the importance of starting now, regardless of your exact age or situation. Every year you delay optimizing your retirement income strategy is a year of potential improvement lost. If you are 55, you have 10 or more years before traditional retirement age. That decade can include continued saving, investment growth, Social Security optimization, and detailed planning. If you are already 62 or 65 and have not done this planning, start today. It is never too late to improve your situation. Even small optimizations, a slightly higher Social Security benefit from delaying a few months, a slightly lower expense level from eliminating waste, a slightly better investment allocation, compound into meaningful differences over a 20 or 30-year retirement. The blueprint I have provided works. It is not complicated. It does not require advanced financial knowledge or expensive advisors. It requires understanding your situation, making reasonable decisions, and executing with discipline. $200,000 is enough to retire on if you manage it wisely. Combine it with maximized Social Security, a thoughtfully constructed portfolio, a sustainable withdrawal strategy, tax efficiency, healthcare planning, and protection against risks. And you can enjoy a secure retirement, that security. The knowledge that you will not run out of money is priceless. It allows you to enjoy retirement rather than spending it anxious about finances. It allows you to be generous with family without worrying about your own needs. It allows you to sleep peacefully knowing your future is provided for. This is what good financial planning delivers. Not wealth beyond measure, but security within your means. $200,000 properly managed provides exactly that. Now you have the blueprint. Use it. Your retirement income awaits.